If you've ever looked at the world of investing and just felt completely swamped by all the options, trust me, you are not alone. But we're going to clear all that up today.
I mean, seriously, when you start digging in, you realize there are thousands of these things. Thousands. Each one has its own little ticker symbol, its own strategy. It's a lot. It's enough to make you just throw your hands up. So the big question is, where do you even start?
Well, here's the good news. Behind all that noise and complexity, pretty much every ETF out there fits into one of just 5 basic categories. Yep, that's it. Once you get a handle on these 5 pillars, the whole ETF universe starts to make a lot more sense.
So, here's the game plan. We're going to walk through these 5 pillars one by one. We'll start with the 2 big ones, the absolute foundation, equity and bond ETFs. Then, we'll get into the more specialized types, commodities, sectors, and thematics. And then, once we've got all the pieces, I'll show you a simple blueprint for how they all fit together in a real portfolio. Ready? Let's do it.
Okay, first up, pillar number 1, equity ETFs. You really want to think of these as the engine of your portfolio. They're the workhorses, the part that's designed to drive your long-term growth.
So what is an equity ETF? Well, put simply, it's a fund that holds a whole bunch of stocks. Imagine instead of having to go out and buy shares in, say, 500 different companies one by one, you could just buy one thing that holds all of them for you. That's an equity ETF. It gives you instant diversification, and its number one job is to grow your money over the long haul.
And here are a couple of classic examples. You've got broad market ETFs like SPY or VOO. These track the S&P 500, which means you instantly own a small piece of the 500 biggest companies in the US. Or you can go even bigger. A total market ETF like VT lets you own a slice of the entire global stock market. Think about that. One purchase, and you're invested across the whole world. It's pretty incredible. All right, so if equity ETFs are the engine pushing you forward, what's our second pillar? That would be the bond ETFs. And if equities are the engine, you can think of bonds as the anchor.
So a bond ETF doesn't invest in company stocks, it invests in debt. These are basically collections of loans made to governments or big corporations. Now, their job isn't to give you that rocket ship growth. No, their purpose is stability. They're meant to provide a steady, predictable income stream and act as a shock absorber when the stock market gets wild.
And just like with stocks, you have options. You can get an ETF like TLT, which holds super safe US Treasury bonds. You could go for LQD, which holds debt from big, stable corporations. Or, just like with stocks, you can buy the whole market with an aggregate fund like AGG, which gives you a piece of the entire US bond market.
This comparison really nails it. On one side, you have your engine for growth, equities, which comes with higher risk and volatility. On the other side, you have your anchor for stability and income, bonds, with much lower volatility. It's this balance, this yin and yang, that creates the strong foundation for almost any solid investment strategy.
Okay, so we've built our foundation with stocks and bonds. Now we can start adding some more strategic layers. Let's talk about our third pillar, commodity ETFs. These act as a hedge.
Now these guys are different. They don't own financial assets like stocks or bonds. Instead, they track the price of real, physical stuff. We're talking raw materials like gold, silver, or oil. And here's why that's important. The prices of commodities often move in the opposite direction of the stock market. That makes them a fantastic diversifier and a popular way to protect your portfolio against things like inflation.
You've probably heard of some of these. The most famous are the precious metals ETFs, like GLD for gold or SLV for silver. But you can also invest in energy with something like USO, which tracks oil prices. Or, if you want a bit of everything, an ETF like DBC holds a whole basket of different commodities for you.
All right, moving on to pillar number 4, sector ETFs. This is where we shift from owning the whole market to making much more specific, targeted bets on the parts of the economy you believe in most. So a sector ETF does exactly what it sounds like. It lets you invest in one specific industry. Let's say you think technology is just getting started, or that healthcare is the place to be for the next decade. Well, you can buy an ETF that only holds stocks in that one area. The potential upside? Much higher returns if you're right. The downside, of course, is that you're concentrating your risk. And here are some of the big ones. You've got XLK for all the tech giants, XLE if you want to invest in major energy players, XLF for the financial industry, think banks and insurance, and XLV for the healthcare sector. It's a way to really put your money where your mouth is. And that takes us to our fifth and final pillar, which is maybe the most exciting of all, thematic ETFs. These are all about looking over the horizon and investing in the massive, disruptive trends that could completely reshape our future. So unlike a sector fund, which focuses on an existing industry, a thematic fund invests in a big idea that cuts across many industries. We're talking about things like artificial intelligence, robotics, or the clean energy transition. Now, these are definitely high-risk, high-potential reward plays. They're the kind of thing that should probably be a smaller, more speculative part of your portfolio.
And you can just see from the examples how forward-looking these are. You have funds like RKK, which focuses on disruptive innovation. There's BOTZ for robotics and automation, ICLN for the global clean energy movement, and Drive for the electric vehicle revolution. These are really bets on what the world's going to look like 10, 20 years from now.
Whew, okay. So we've covered all 5 pillars. We have our engine, our anchor, our hedge, and our more targeted bets. Now for the most important part. How in the world do you put all of these pieces together? Let's look at the blueprint.
One of the most popular ways to do this is something called the core satellite strategy. And the idea is actually really simple. You build the huge majority of your portfolio, your core, using those broad, stable equity and bond ETFs we talked about first. Then, use a much smaller amount of your money to add some satellites, those commodity, sector, or thematic ETFs that let you take a shot at specific ideas without risking your whole nest egg.
And this chart is a great way to visualize it. See how the vast majority of the portfolio, 90% in this case, is locked into that solid core of stocks and bonds? That's your foundation. Then you have that small 10% slice dedicated to your satellite bets. Now, of course, your personal numbers might be different depending on your age and how much risks you're comfortable with, but the principle is what matters. A big, stable core surrounded by small, targeted bets. So there you have it. You don't need to feel lost in a sea of thousands of ETFs anymore. By just understanding these 5 pillars, you have the blueprint. You have the tools to navigate this world and start building a portfolio that actually makes sense for your goals. So the only question left is, what are you going to build?